What's up, you guys? Today we're going to talk about stocks versus real estate. So if you invest in stocks, and we do, by the way, we want you to watch this video, and please watch it to the end because we want you to make money. We are in the real estate game, not because it is just something we prefer because it's, I don't know, we grew up in real estate. We definitely did not. It's because it is the best for your money, and we're going to explain right now. So let's just say we're going to be very realistic, in fact a little bit conservative on the real estate side, but very realistic on the stock side. So here we go, stocks versus, I'll go keep it separate, let's go RE for real estate, right? Okay, so stocks, let's say you've got 50K saved up, awesome job, good on you, and you invested that in, say, Tesla, or just any whatever. 8% is about what you're probably going to make. So you made 8% on that 50K. Great job. What does that translate to? That's $4,000. That's awesome. You made $4,000, and this is going to be, by the way, in a 1-year scenario. So $4,000 is definitely nothing to laugh at. It's going to be a nice trip to Vegas or something. But oh, don't forget, you've got some taxes to pay. Uncle Sam needs his share as well. You're now down to $3,400. Still, that's good. That's awesome. That's better than just leaving it under your mattress and losing 2% on your money. So, awesome job, but it could be way, 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 way better. In fact, 4 times better. Tell them how it's done.
Yeah, so a little note about this is Andrew's talking about is the long-term capital gains rate. Now, if you end up selling it faster, you will be considered a trader and you will be paying an ordinary income tax rate that could be as high as 40-50%. Mm-hmm. So also, you only get this money if you sell the stocks, right? Or if you sell the fractional amount of the stocks. So if you do that, you're back to 50K. You no longer have $54,000. Mm-hmm. So important point. So now let's go to real estate, right? So the big difference between stocks and real estate, I always want to tell people, or educate them about is, with real estate, I can go to a bank and borrow money to buy real estate. I can't go to a bank with $50,000 and say, hey bro, I want to buy $250,000 of stocks for Tesla. They'll laugh at you and kick you out, right? So with this, I can. In fact, with $50,000, we can buy $1 million of real estate, but we're not even going to go there. We're going to keep it super conservative. Mm-hmm. 50K, we buy 250K worth of assets. Actually, our first property we bought was very similar. We put 50-60 and we bought something for $250,000. So 20% down.
20% down, yes.
This is 20% down, right? So this is 20% down. So with this, real estate is a little bit complicated, so we're going to keep it super simple. If anybody knows the 1% rule, 250K is about $2,500 per month is the amount of rents you can collect. That's how much we collect. We collect a little bit more, we get 27, but we'll keep it at 25. So let's do all the numbers per year. So this is going to be 30K in cash flow. No, sorry, 30K in total rents. This is going to be 30K in total rents. And remember, we have to pay a mortgage on this, and then the mortgage is going to be about 14K, let's say at 4% interest rate, about $14,000. But now we also have expenses, so a conservative number will be 40%. So 40% of gross receipts in collected rents will just go to expenses. You got to pay taxes, property management, the toilet's broken, you know the game. So 12K, right? So if you add these two up, you're going to get about 26K. You minus it from that, so your NOI for the cash flow is going to be about $4,000, right? So that's pretty good number. So now the difference between stocks and this is, this $4,000 will never pay income tax. Our properties currently make gross is over $150,000. We will pay $0. We actually won't even pay $750. We will pay zero. We'll always pay zero. That's how real estate works, right?
Because of the tax advantages given to us because we invest in real estate.
Yeah.
Whole different video.
Whole different video. I'm going to go on a tangent on that because people think the tax code is actually written to pay taxes. Actually, 99.5% of the tax code is to say how you should not be paying taxes. 0.5% is for paying taxes. So
that's how you do it.
The government wants you to invest in real estate. Anyhow, so we got 4K in cash flow, right? So let's talk about more benefits, right? Somebody else is paying the mortgage, right? So it goes with principal and interest, right? So the principal is actually equity going back into the property. So that's unrealized gain. So that's about another $4,000. and the appreciation, right? So real estate appreciates about 3% per year, but it's not on the money you invested, it's on the asset you bought, right? So if you only put a quarter of it, 3% times a quarter will actually be 12% on your money. Just with that alone, you already beat the stocks at 8%, right? So real estate is like a joke, like if you don't invest in it. So now we're talking, what is the number for appreciation? It's about $8,000, right? So now we are at 16K for the first year, right? Out of that, 4K is actually usable. You could actually go to the store and buy something. With this $3,400, you're not buying anything. It's still in the stock market.
This still grows even if you use that 4K.
Even if you keep taking the 4,000 every year, my 3% appreciation based on the 250K purchase price, it's always going up.
Yep.
But if you take the money out of the stock market, you're back to 50K. You use that again, you're back to 50K.
Back to square one.
End of 100 years, you have $50,000. We have 10 properties.
Awesome. So you're already seeing that we have now captured over four times the amount as you would had you invested in stocks versus real estate, right? Not sold yet? Cool. All right, let's just go ahead and have some fun and talk about what would happen in that same scenario in 10 years. So we're going to have some compound interest, right? It's kind of exciting. Stay with me. Don't fall asleep. $108,000 would be what you would have in 10 years if you invested at 8% with compound interest. You didn't touch it. You can't touch this, by the way. So out of that, that was your initial investment here, the $50,000. So your total profit is $58,000. Okay, in 10 years, that's freaking awesome. But you're going to pay taxes again. Uncle Sam's going to want a little bit. So at 15%, you're going to be paying $9,000 in taxes. Okay, that's fair. So you're left with $49,000 in 10 years. That's actually awesome. That's great. That's better than leaving it, in a box somewhere where you're going to lose 2% to inflation every year. But it's not good enough for us. And so Vince is going to tell you exactly how that works.
Yeah, so also to stress the point, when Andrew says you actually made $49,000 in 10 years, that means you owned something for 10 years and you made nothing on it. Like it's just sitting somewhere. You did not make $49,000 if you took the $3,400 every year, right? Because
Yep.
you will be back to $50,000.
Yep.
So you're saying that you bought something for $50,000 and then you let it sit for 10 years and you got nothing out of it. At the end of 10 years, you can get $49,000. Now, remember, if you pull the $49,000 out, your asset is not worth $108,000. You're back to $50,000 again. So at the end of 50 years, if you use the money, you go back to nothing. You go back to the $50,000. It's like, this is not a plan to retire. This is like nothing. This is garbage. Like, I wouldn't even do this. Now, you would think that we don't have any money in the stock market. That's why we are like all about real estate. We have like over $100,000 in the stock market. Like, but it's like garbage. Like, it's not worth anything to
It's
us.
on the side.
It's like, it's whatever. Now, if your company matches and stuff, you should put your money in 401k. That's pretty good.
Another video as well.
But let's go into what happens with
10 year
year for my real estate side, right? So
Yeah.
let's see what happens there. I'm gonna make it more complicated a little bit. So this is how we do it, right? So we own a few houses, and let's just talk about this one. So end of 10-year mark on the first house, right? Cash flow. This is assuming our rents never go up. Our rents go up 3%. We live in California. My rents have gone up by $1,000 in 5 years, right? So saying rents don't go up is almost stupid. Like it always goes up. But we are saying we are not even playing that game. It's just keeping the same rents, right? So cash flow is 40K. Remember NOI minus all the expenses and mortgage debt service. So you get the NOI. So then you have mortgage pay down, right? Mortgage pay down is about another 40K, and then you have appreciation. So remember this compounds. Even though we use the money, it doesn't matter. The asset value keeps going up. So that's $86,000, right?
Yep.
So you're looking at $166,000 for just the house one. Now check this out, right? So remember, with real estate, you can actually have the cash in your pocket, right? So at the end of 4 years, you have about $80,000, out of which 40K is from the cash flow, right? So $80,000. That's almost you can buy 2 more houses, but we'll keep it even ultra simple, right? So I can go borrow this money from the bank, and then I could go buy another house at the end of 5 years.
So you're saying in 5 years, you decide you're going to pull out some of that equity and just do the exact same deal again.
Same deal. Everything is the same, right? So what happens? You get another 20K, and you get another 20K here, and then it appreciates another 20K, right? Is it no 40K? Appreciates 40K.
40K.
Yeah. So that's another 80K.
Yep. $80,000.
So we got another $80,000. You add this guy to here, total comes to about $246,000.
House 1, house 2, right? This one, 166K. You got this one for the full 10 years. That's property 1, right?
Mhm.
Property 2, you've held this for 5 years.
Mm-hmm.
This one right here is, what was it? 80, 86?
80K.
80K. 80K. Add those two together, you got yourself $246,000.
In realized and unrealized gain, right? So a lot of the money we can use. We're not even talking about tax benefits. When we pay for gas, when we go out to eat, we write everything off against the assets. So in fact, if you make less than $150,000 and stuff, you can actually take and minus your income from your other sources. Talk to your CPA. But that's how it works. It's a whole different game. Now the total asset that we are controlling at the end of 10 years is actually 625K. That's with compounding and appreciation, just 3%. Sometimes it's more. 625K. No matter what we're doing with the money, we could be going to Vegas, gambling with our money.
Yep.
We will still have an asset that's worth 625K. Here, you would have nothing. You would have $50,000 if you spend the 49K. So,
And I actually did some quick math just for a second, just for fun. This right here compared to this number is 5 times the amount. We're not even talking about what you're controlling in assets. We're just talking about that simple number. 5 times the amount. So this is why we do real estate. It's not because of any other reason besides it is the greatest vehicle to grow your wealth. Anything else you want to add?
no, I think they're good. I think
Awesome.
it's all a lot.
Well, thank you so much, you guys. And probably your heads are spinning right now. But if you guys didn't follow any of that, please comment below. I think what I'm going to do is probably put up like a little PDF with all these numbers on it as well. Please reach out and let me know if you guys have any questions. Like this video, share what you feel could benefit from it, and we'll see you in the next one.